Welcome back. So, something really strange is happening in the financial markets right now. A fundamental rule that investors have trusted for decades seems to be breaking. And today, we're going to play detective. We're going to piece together the clues to figure out exactly what's going on and, more importantly, what it means for all of us. Okay, so for as long as most of us can remember, investors have relied on a very simple safety mechanism. It's right there in the old rules. When stocks fall, government bonds rise. They act like a seesaw, a financial cushion for your portfolio. But today, that relationship has completely shattered. As you can see, both stocks and bonds are falling, together. The traditional hedge has failed, and that, my friends, is the mystery we need to solve. So, to really understand why today is so weird, we first have to understand the standard procedure. Let's call it the whisk-off playbook. This is the totally predictable chain reaction that we expect to see whenever investors start to get spooked. So what exactly is a risk-off event? Well, think of it like a storm siren going off in the market. Everyone panics, they start selling off their riskier assets, like stocks, and they run for the safest shelter they can possibly find. And for decades, that shelter, that safe haven, has been government bonds. This playbook almost always unfolds in three predictable acts. Step 1, fear spikes, and investors dump their stocks. Step 2, all of that money then floods into the perceived safety of the bond market, which naturally pushes bond prices up. And for step 3, the US dollar, being the world's reserve currency, gets stronger as global money searches for a safe harbor. It's a classic, reliable sequence. Or it used to be. All right, now that we know the old rules, let's put on our detective hats. The clues from the market today are telling a very, very different story. And frankly, they just don't fit the standard playbook at all. And here is our first major clue, a massive one-day spike in oil prices of over 8%. Now, this is really odd. I mean, if this were a typical growth scare, investors fearing a recession, demand for oil should be falling, which would mean lower prices, not a huge spike like this. This points to something else entirely. And the plot thickens when we look at the other assets. So oil is up sharply. Check. The dollar is also up, which, okay, that fits the playbook. But look at gold, another traditional safe haven. It's down. An oil spike combined with a drop in gold, that is a very specific, very strange signal that tells us this is not your garden variety market panic. So this brings us right to the heart of the matter. We've pretty much established that this isn't the usual fear of a recession. The evidence just doesn't line up. So what is actually driving all this chaos in the market? Okay, we've gathered our clues, we've seen all the contradictions, and now I think we can make a diagnosis. It's time to finally unmask the real cause behind this whole market mystery. And here it is. This is the aha moment. The diagnosis is actually pretty simple. This is an energy shock, not a monetary panic. See, the fear isn't about the financial system collapsing or a lack of money. It's a very targeted fear, and it's centered entirely on the supply and the cost of energy. To put it another way, the market isn't worried that people are going to stop buying things. It's worried about the cost and the availability of the energy needed to make and transport those things. This is what we call a supply-side shock. And it means the big bad wolf, inflation risk, is sneaking back into the economy, this time through the side door of commodities like oil. Okay, so we've identified the culprit, an energy shock. But so what? Why does this specific type of shock have such a dangerous knock-on domino effect, not just on the global economy, but on your portfolio too? Well, this thing has three major consequences. First, and this is the really critical one for investors, the bond market hedge is gone. Your portfolio's safety net is broken. Why? Because the fear of inflation from this energy shock is keeping bond prices down. Second, that combination of a strong dollar and high oil prices creates a global squeeze, putting immense pressure on any country that needs to import its energy. And third, that weird behavior from gold, it's the smoking gun that confirms it all. This isn't a broad sell-everything panic. It's a problem focused squarely on energy. So the really crucial takeaway here is how this impacts a normal, balanced portfolio. Now, the fancy Wall Street term for this is a negative convexity regime, which is just a complicated way of saying your safety nets fail you exactly when you need them the most. Think of your portfolio like a two-legged stool. You need both legs, stocks and bonds, for stability. Well, in this environment, both legs are being kicked out from under you at the exact same time. Which, of course, leaves us with the final and most important question of all. What happens next? Is this just a temporary tremor that the market can shake off? Or are we actually witnessing the beginning of a whole new economic reality? Look, if this energy shock proves to be more than just a quick spike, the road ahead could get pretty rocky. You should expect much higher volatility. And I'm not just talking about day-to-day swings, but a real fundamental uncertainty rocking both stocks and bonds. We'll probably see a lot more pressure on long-term assets. And that strong dollar we talked about, it starts to act like a global boa constrictor, tightening the money supply and creating serious financial stress all around the world. And so we're left with this massive question hanging in the air. The old rules are clearly being challenged. Is this just a brief shock the market can absorb and get over? Or are we walking into a new reality where the traditional safe havens don't offer any safety at all? That is the mystery that's still unfolding.